Hi again folks, welcome back to Meaningful Money. Where are we? We're, well, slightly above West Penwith. You might be able to see a church tower on the horizon. That's St Buryan village. And we're on the way to Carn Uni, which well, hopefully I'll talk to you about in the next video. We talked about shares last time. This time it's property. We're still talking about the basic building blocks of portfolios. The things which make up basic investment. And so today is property, which falls broadly into two camps: residential property and commercial. So residential property is houses, flats and stuff like that, and normally the form that takes is buy-to-let investment, where you buy a house and let it out. Nothing wrong with that at all. There's a lot of people made a lot of money out of doing that. But it takes quite a lot of money to invest in that way, or it takes rather a large mortgage if you're going to build up a portfolio of properties. And there's risks involved with that, which I'll come to at the end of this video. But you can also get residential property funds, but they're quite rare. So the other side of property investing is commercial property, and by that I mean offices, shopping centres, industrial estates, things like that. Now, it's not very easy for you or I to go and buy a shopping centre. We probably haven't got the 25–35 million pounds required to do that. So for most ordinary investors, the way they get access to property is through a property fund. We talked about funds 2 or 3 videos or so ago. Property funds fall again into two types: bricks and mortar. So that's funds which buy actual physical properties. So for instance, if you happen to live in Farnborough watching this, well, the Standard Life Property Fund owns the Prince's Head shopping centre in Farnborough. Never been there, I'm sure it's lovely. So bricks and mortar properties on one side, but also funds can invest in the shares of property companies, so maybe house builders like Persimmon or Redrow Homes, something like that. And of course there's funds which do both. We're talking particularly though about bricks and mortar property, and there's some things you need to be aware of. Firstly, properties are difficult to value because it's extremely subjective. So if I'm a fund manager and I have a shopping centre in my portfolio, then that's got to be valued pretty regularly so that I can report the value of the fund to my unit holders. And that's quite a process really, and it doesn't sort of happen every second of the day like a share is valued. It might happen once a month or once a quarter or something like that. And so that means that property fund valuations are, well, they're tricky to value. Property fund managers hold a lot of cash in their funds. The main reason for that is property is illiquid. Now that's a technical term, and it means it's difficult to sell, or it can be. Or if not difficult, it can take time to sell. My mum and dad know a thing or two about that. They've been on the housing market for nearly 3.5 years and are still waiting for a buyer, but that's perhaps the world that we're in at the moment. But you imagine it's even more difficult to find a buyer for a £35 million shopping centre. So property can be illiquid, and because of that, property fund managers will hold cash. Because if I'm an investor in a property fund and I want my money out, I don't really want to wait until the fund manager sells the Prince's Head shopping centre in Farnborough in order to give me my money back. So a property fund manager will hold cash so that they can pay out people who want to withdraw their money, and also so that they can buy more property if the opportunity arises. That illiquidity though can sometimes mean that if you're invested in a property fund, the fund manager has the right to delay paying you your money out even if you ask for it, and sometimes that's called a moratorium on encashment, and that delay can be 6 or even 12 months. So it's just a couple of things to be aware of. But I think the key things with property: up to about 3 years ago, property was deemed to be very low risk and essentially a one-way street. So values were going sky high. There was hardly any volatility. Prices didn't go up or down, they just went one way. And the property boom of the late 90s, I think that's a wasp, get off. See, this is the danger of doing it outside. I'm going to get stung and I'm going to have to muscle through it. In the property boom of the 90s, my chopsticks. Right, where was I? I imagine I'll probably leave that in for your amusement. In the property boom of the late 90s and early 2000s, property values just going one way, and it was deemed as a very low risk investment. But that's simply not true. If you come across an advisor who tells you that a property fund is a low risk, you need to walk out the door and find a better one, because just in the last 3 years, one of the standard indices of property has dropped by 25% over the last 3 years. So that's hardly a low risk investment. I imagine you'd be pretty knocked if I sold you a low risk investment and then 3 years later you'd lost a quarter of your money. So that's property. A couple of things to be aware of: it's illiquidity and things like that, and the fact that it behaves differently to shares and bonds and things like that, and that's why it's useful to have it in a portfolio. Remember, when you're diversifying your portfolio, you have to have things which behave differently in order to reduce that risk. So that's property. I'm going to walk a little bit further along this path and we'll do the next one, which I think is going to be about commodities. So see you next time.